In order to understand the recession, it is important to look at the state of banking in the years leading up to 2008. By 2006, subprime mortgages were being written, and banks were lending to candidates who may not have been able to meet traditional underwriting standards. These types of risky mortgages were standard, and when housing prices began to fall in 2006, many mortgages were at risk of being underwater. Being underwater on a mortgage occurs when the value of a property is worth less than the outstanding mortgage amount required to pay it off. In 2007, the Federal Reserve encouraged banks to work with lenders to come to new arrangements to help borrowers avoid foreclosure. The Federal Reserve lowered interest rates to 4.25% by the end of the year, but its actions were not quick enough, nor were rates low enough to improve the market. By July of 2008, the recession had impacted the economy and the country's GDP fell by 0.3%. Shortly after, Fannie Mae and Freddie Mac were failing, and the government announced plans to take over both entities to avoid a full collapse. In September of 2008, the Dow Jones fell 777.68 points in a day, and at that time was the biggest drop in points recorded. The crash occurred as a result of Congress rejecting the bank bailout. In October 2008, Congress established a bank bailout of $700 billion through the Troubled Assets Relief Program. Congress passed the American Recovery and Reinvestment Act as part of a $787 billion economic stimulus plan, granting $282 billion in tax cuts and $505 billion for new healthcare, education, and infrastructure projects. President Obama also announced the Homeowner Stability Initiative, a $75 billion plan created to assist homeowners who were at risk of getting behind on their mortgage payments. The Homeowner Stability Initiative did not convince banks to change their lending standards. The Dow Jones dropped to a low of 6,547.05 points, representing a total decline of 53.8% from its peak in October 2007. In March of 2009, the Obama administration launched the Making Home Affordable initiative to help homeowners avoid foreclosures, creating 1.7 million loan modifications during the program. In August of 2009, President Obama asked banks to modify their loans, but banks did not agree to do so. Modifying loans to prevent foreclosures would have hurt the profitability of the banks, and they did not have incentive to change their practices. Foreclosures hit an all-time high, with 360,149 foreclosures logged in July of 2009. This was a result of many adjustable rate mortgages becoming due at higher rates. In October 2009, banks were not lending at the same levels before, with lending down 15% among the nation's 4 biggest banks. The banks were preparing for write-offs while saving the subsidies they received from the government. So, what ultimately caused the Great Recession? The changes in mortgage lending standards from the banks set the stage for a housing bubble to be created. The government put rules into place that required banks and lending institutions to offer loans to more individuals from low and moderate income households. These rules allowed people to contribute a smaller down payment toward their purchase and get more for their money in terms of property value. Fannie Mae and Freddie Mac were government-sponsored entities that were privately owned but also had federal sponsorship. The entities both had the ability to borrow funds at a rate of 50 to 75 basis points lower than other private lenders, which provided them with a competitive advantage. Fannie Mae and Freddie Mac were in the unique position of serving both stockholders and Congress, which meant there were often objectives in conflict of each other. Their lobbying involvement of various politicians allowed a unique position of favoritism and regulations that worked to their advantage. The entity's involvement within the secondary mortgage market and ownership of approximately 90% of those mortgages meant that they were allowed to directly influence lending standards. Banks knew that they could write risky mortgages because Fannie Mae and Freddie Mac would purchase both the mortgage security and the risk associated with it. Because borrowers did not need to meet such difficult or high standards to obtain a mortgage, demand was up, therefore increasing the price of housing. The rate of foreclosure and the default rates of these subprime mortgages would go on to hurt the market and drive prices down. For businesses, it is essential to understand how the company is leveraged. The leverage ratio of a company is the ratio of loans and investments to capital assets. Rules put into place by the Securities and Exchange Commission in April of 2004 allowed banks to increase their leverage ratio beyond what was appropriate to maintain business. Leverage ratios of banks prior to the rule change were typically 12-1, and rule changes put into place by Basel I regulations allowed a leverage ratio to be as high as 60-1. This occurred because the normal rules of maintaining at least 8% capital against assets were reduced to 4% for mortgages and 1.6% for securities. The banks viewed the risk associated with mortgage-backed securities to be low, therefore catching them off guard once foreclosure rates increased. The values of the securities fell drastically, and banks did not have the funding to pay their obligations. Officers who had yearly bonuses had incentives to take big risks in hopes for a massive personal benefit. The government planned for its market intervention to assist American families with home ownership. However, the Community Reinvestment Act of 1977 and Congress's mission to increase rates of home ownership among lower income and minority families caused a negative impact within the housing market. The primary goal of the Community Reinvestment Act was to eliminate the practice of redlining. Redlining was a practice of both the federal government and banks to actively avoid lending to borrowers in minority and lower income areas. Despite good intentions, government intervention has the potential to alter the market in a way that changes how the market would have worked on its own if it had been left to run freely. Requirements of the Community Reinvestment Act and the affordable housing regulations encouraged banks to offer loans to less desirable candidates by reducing the requirements needed to obtain a mortgage. Fannie Mae and Freddie Mac began to accept loans with reduced requirements, which then led to those same lowered requirements being offered to borrowers who could have qualified for a mortgage under traditional standards. The percentage of American households who own their own home had been at 64% for about 25 years, but rose to 69% as a result of these fiscal policies. This led to home prices doubling between 1995 and 2007, contributing to the bubble. The reduced standards, in conjunction with the tax deductibility of interest paid on mortgages, meant there was less collateral and fewer incentives to borrow responsibly, with some borrowers taking out mortgages beyond their budget. The action of the Federal Reserve to keep interest rates low during 2002 to 2004 alone did not cause the recession, but its low interest policy, in conjunction with HUD regulations and minimal down payment requirements, all led to the growth of subprime and adjustable rate mortgages. The Federal Reserve uses the Federal Open Market Committee to determine if interest rates need to be raised or lowered. The goal of the Federal Open Market Committee is to promote maximum employment, stable prices, and moderate long-term interest rates. The interest rate is increased by the Federal Reserve to fight against inflation as a way to improve conditions that may lead to a recession. However, the Fed kept rates at all-time lows between 2002 and 2004, increasing demand for housing. This added on to the problems created by the lowered mortgage standards and reduced barriers to home ownership. In 2007, the Federal Reserve reduced the rate multiple times until it reached 4.25% at the end of the year. This move was intended to restore liquidity and confidence, but the move was too little too late when an earlier drop in interest rates may have allowed more time for correction within the market. The way banks choose to lend has led to better outcomes for American homeowners. Mortgages written now have only a 2.3% risk of default versus 16% in 2006. A smaller proportion of applicants are approved for mortgages now because banks have become more cautious in their lending strategies. This means that banks are getting pickier, and those who are offered loans are likely to be better candidates overall, with a higher likelihood of being able to meet their financial obligations. Credit scores have increased to a high of 703, and homeowners today have $15.8 trillion in home equity versus only $6.5 trillion in 2008. Due to higher levels of equity overall, there is an indication that fewer borrowers will be at risk of easily going underwater with their mortgages. However, changes in lending restrictions within the Dodd-Frank Act and low interest rates have the potential to put the market at risk again in the future. In order for future recessions to be avoided, rules need to be put into place that do not incentivize risky behavior. Loan originators need to be held responsible for the loans they write, whether or not those loans are sold off to other companies. By forcing these companies to take responsibility, there is less incentive and greater risk associated with writing a risky mortgage. Companies that pass along mortgages to other companies should not be able to pass along the risk. Banks were incentivized to continue making risky investments and over-leveraging because they had confidence that the government would bail them out if bankruptcy became a looming threat. Officers within these banks are offered big bonuses when they bring in big profits, but there is little risk associated with making a bad investment. If a risky investment pays off, the officer receives the bonus. If the risky investment does not pay off, the officers themselves are not responsible for those choices. Instead, the bank would be bailed out by the government. In order to discourage this type of behavior, the government must stop guaranteeing the losses of big banks. Big banks will be forced to alter their investment strategies and risk models to make more considerate choices if they know the government will not step in to help if their investments go underwater. Tax benefits associated with mortgage interest needs to be aligned with increased qualifications for home ownership. Tax laws that allow for large mortgage interest payments to be tax deductible in conjunction with low down payment requirements and low interest rates allow buyers to enter the market who may not be ready to do so. By taking all of these measures together, there will be less incentive for banks to lend to undesirable candidates and for buyers to purchase beyond their means.